As of early February 2026, the global gold market is witnessing a historic paradigm shift, with the spot prices firmly establishing a new floor above $5,500 per ounce. This represents a staggering year-over-year appreciation of over 70%, with the metal recently touching an all-time high in late January. The psychological barrier of $5,000 an ounce, once viewed as an extreme upside scenario, has now converted into a critical support level. Volatility remains elevated. A single-day surge on January 21st, 2026, saw prices jump nearly 2% following trade dispute escalations, while profit-taking bouts have seen sharp but short-lived corrections. The market has effectively rebased, decoupling from traditional resistance levels and defying the historical inverse correlation with real interest rates. The catalyst for the most recent price explosion is the deterioration of transatlantic relations. Specifically, the Greenland access dispute has triggered renewed trade war signals between the United States and the European Union, injecting acute risk premiums into global markets. This diplomatic standoff, combined with ongoing NATO-Russia tensions and instability in the Middle East, has created a polycrisis environment. Investors are no longer hedging against singular events but against systemic geopolitical fragmentation. The reemergence of the America First doctrine under the current U.S. administration, exemplified by aggressive tariff postures, has further isolated the dollar, driving capital into non-sovereign stores of value. Central bank accumulation has evolved from strategic diversification to an urgent imperative. In 2025 alone, net official sector purchases exceeded 1,000 tons, extending a multi-year trend of record buying. Emerging market central banks, led by China, Russia, and increasingly India and the Middle East, are aggressively swapping U.S. Treasury exposure for physical bullion. This is not merely portfolio rebalancing, it is a defensive maneuver against the weaponization of the U.S. dollar. The sanctions risk has convinced sovereign actors that gold is the only reserve asset free from counterparty risk and political seizure. The global economy is grappling with a crisis of credibility regarding fiat monetary systems. The U.S. national debt has breached $38 trillion, with projected deficits widening under the newly proposed One Big Beautiful Bill Act, which analysts warn could expand the deficit by $3 trillion over the coming decade. Despite the Federal Reserve's rate posture, inflation expectations remain unanchored due to fiscal profligacy. Gold is rising alongside yields, a rare anomaly signaling that investors fear debt debasement more than they fear opportunity costs. The U.S. dollar index, DXY, is facing structural headwinds as the petrodollar system weakens and bilateral trade agreements in local currencies proliferate. Institutional inertia has broken. Major banks like J.P. Morgan and Goldman Sachs have revised their year-end 2026 targets upward, with some bull case scenarios now extending to $7,000 an ounce. Global gold ETFs have seen inflows surpassing $100 billion in the last quarter alone, reversing years of outflows. Retail demand remains robust, particularly in Asia, where physical bar and coin premiums have hit multi-year highs despite record spot prices. We are no longer watching a bull market in precious metals. We are witnessing a vote of no confidence in the post-1971 monetary order. For decades, gold was treated as a safe haven, a temporary bunker to hide in during storms. What we see in 2026 is fundamentally different. Gold is transitioning from a hedge to a primary collateral asset. The recent flashpoint over Greenland is not just about mineral rights or territorial pride. It is a symptom of the disintegration of the Western alliance structure. When the U.S. and Europe threaten trade wars over resource access in the Arctic, the entire premise of Western unity fractures. For the Global South, the BRICS Plus bloc, this is the ultimate signal to exit Western financial architecture. I believe we are seeing the early stages of a bifurcated global economy, where gold serves as the only neutral settlement medium acceptable to both East and West. The U.S. hitting $38 trillion in debt is a mathematical inevitability we all foresaw, but the market's reaction is the news. In the past, high treasury yields crushed gold. Today, they rise together. Why? Because the bond market has realized that the only way to pay off $38 trillion is to print it. We are in a fiscal dominance regime where central banks have lost control to treasuries. The One Big Beautiful Bill Act is simply the latest iteration of fiscal expansionism that guarantees currency debasement. Investors aren't buying gold to get rich. They are buying it to avoid becoming poor. A crucial underreported angle is the intersection of gold with the AI and tech boom. While we focus on monetary bars, industrial demand is quietly firming. As we build out the massive data centers required for the AI revolution, the reliability of conductive materials is paramount. While gold's industrial use is a small fraction of demand, in a market this tight, any inelastic demand on the margin forces prices higher. We are approaching peak gold production. Miners are struggling to replace reserves, and with energy costs rising, the floor price of production is moving up, likely sitting near $3,000 an ounce today. I anticipate we will see $6,000 per ounce for gold before the end of Q3 2026. The volatility will be nauseating. 10% drops in a week will become common as leveraged longs get washed out, but the vector is undeniable. Unless there is a miraculous restoration of global diplomatic trust and a simultaneous balanced budget in Washington, both effectively impossible, the path of least resistance is higher. We are watching the remonetization of gold in real time.